So we total up our operating expenses. We get
And
40.
Tim, quick question, Tim. So in the depreciation example, when you mentioned the 1 million divided by 5 years, that 5 years was the length of time that equipment would last, or?
Yeah, it's what's considered the lifetime of that fixed asset.
Okay.
And that's something, again, your accountant, it could be whoever you buy the equipment from could tell you, yeah, on average, this piece of equipment's going to last you 5 years, or something your accountant, based on a little bit of research, could tell you as well. Good question. All right, so we've got our operating.
With that,
yeah.
Sorry, why exactly does this depreciation thing exist like that? Why is it not? Because if we pay for it all at once, typically, I don't know, I'm sure there's some things that we pay for in installments, but I would think that in my case, the most depreciable thing I have is my build out, which is not showing up in a depreciation category. It's showing up as a fixed asset. So I don't know if that's right or not.
Yeah.
In any event, that's, I would think, my most depreciable thing. It's already paid for, right? I already paid for it. That money's already gone. So why is it going to be accounted for in segments over time?
That's a very good question. And the best answer that I can give you is the way the IRS looks at that number is, while you may have paid for it up front, whether it's, like you said, the build out of your store, or if you're buying a big expensive piece of equipment, while you laid that money out up front, you haven't expensed it yet. And what the IRS is interested in is not your investment, but they're interested in terms of calculating taxes. They're interested in looking at your income and your expenses. And it doesn't become an expense until it's put into use over a period of time. And that's why they force you to expense it typically over the lifetime of that asset. So it's an accounting procedure where they're differentiating between your purchase of the asset and the expensing of that asset. And the IRS sees those as two distinct activities: purchasing the asset and expensing the asset. Does that help?
A little bit.
That's all I've got. That's all I've got on depreciation.
Yeah.
All right. So we subtract our operating expenses. We get an operating profit. In this case, a loss. Anytime you see something in parentheses, that means it's a loss of $37.50. We then subtract our income tax, our interest expense of $11.29, and we get a net profit, or in this case, a net loss of $48.79. $48.79 for the month of January. So, Michael, let's just assume for a moment this is your company. We're looking at your income statement, net loss of $48.79 for January. How was January? How was the company performance in January based on this statement?
January, to me, January is pretty good.
Good.
Yes,
Yep, we had revenue of $88,000. We had a gross profit. We did take a loss at the end of the month. So here's the seed I want to plant when looking at an income statement. As important as this information is on the income statement, we're not getting the whole story. We're getting a piece of the financial story, because what we don't see on this income statement is, well, what was our profit in December? If our profit in December was $50,000 and we took almost a $5,000 loss in January, you'd be thinking this is a pretty crappy month. If in December your loss was $100,000 and your loss in January was $48.79, you might be thinking, wow, January was a much better month. So what we're missing here is anything to compare these numbers to. So I say that just to be careful when you're looking at your own income statement. Be careful to judge your financial performance just based on this one financial report, because it's an incomplete story. This report by itself is an incomplete story. Valuable information, but an incomplete story. Okay.